Intel is back. Or, well, that's exactly what the massive headlines plastered across every major financial news network would have you believe right now. Welcome to The Explainer. Today we're looking at the supposed greatest tech turnaround story of our time. You've probably seen all the news lately: a massive government bailout, enthusiastic wall-to-wall coverage, and NVIDIA seemingly riding in to save the day with a massive $5 billion check. The hype is literally everywhere, and the momentum feels absolutely unstoppable. And man, that hype is driving some truly massive numbers. Look at this, a staggering 550% stock surge. The mainstream media is celebrating this as an incredible victory. For anyone just glancing at a stock ticker, it looks like America's legacy chipmaker has finally cracked the code to dominance once again. But whenever we see a narrative this unified and a surge this aggressive, it's our job to look past the ticker and dig into the actual data. So that brings us to the real question we have to ask today. Is this a genuine turnaround story, or are we just looking at a fragile house of cards? We're not going to just blindly trust the headlines today. Instead, we've dug directly into Intel's own SEC filings, leaked internal data, and the whispered reality coming from inside their own fabrication plants. What we found reveals a staggering truth that insiders know all too well, but for some reason just aren't sharing with the public.
All right, let's dive into it. We're going to systematically dismantle this illusion by looking at 5 distinct red flags. Number 1, the yield crisis. 2, the foundry black hole. 3, the credit trap. 4, the political stranglehold. And finally, number 5, the ugly truth revealed. Let's get right into the data.
Red flag number 1, the yield crisis. This whole thing centers around Intel's 18A process, which was supposed to be their big miracle move to dethrone rival TSMC. But the internal numbers, they reveal a pretty devastating reality. Leaked data from summer 2025 showed Intel's yields for this crucial process sitting at roughly 10%. Now, to put that into perspective, to actually turn a profit, the industry standard needs to be up around 70 to 80%. So a 10% yield? That literally means 9 out of every 10 chips coming off their manufacturing line are completely defective. 9 out of 10. So even if executives dispute the exact specifics without giving us their own numbers, the underlying math is brutally clear. If you're selling their new Panther Lake chips at these yields, you are selling them at a massive, massive financial loss.
So how did they even get here? Well, Intel is currently attempting to introduce 4 major new technologies all at once. Inside the industry, we call this a technological Hail Mary. It's a wildly desperate, incredibly high-risk play. But as former execs have pointed out, they kind of brought this crisis on themselves. For a whole decade, Intel prioritized spending billions on stock buybacks instead of, actually investing in critical ASML lithography machines, those ultra-expensive, highly specialized printers you absolutely need to make modern chips. Basically, we're watching a decade of severe mismanagement finally hit a brick wall.
Which brings us to red flag number 2, the foundry black hole. Intel's foundry business, their division for building chips for other companies, was touted as the absolute future of the company. But right now, that future looks a lot more like a bottomless pit. Just look at this incredible cash bleed. It starts at $7 billion, nearly doubles to $13 billion in a single year, and then sits at $9.5 billion in another. And Wall Street analysts, they're projecting this division is just going to keep hemorrhaging cash until at least 2027. You simply cannot survive numbers like this in the contract manufacturing business unless you secure a massive hero customer to foot the bill and actually fill up your factories.
And hey, that brings us to NVIDIA. The whole market basically assumed Jensen Huang and NVIDIA were swooping in to be that hero customer to save Intel's foundry. But listen to this quote from industry analyst Anshul Sag. "I was expecting that NVIDIA was going to announce some sort of contract manufacturing deal. It didn't happen." Yep, you heard that right. That highly publicized $5 billion deal with NVIDIA, it explicitly excluded the foundry business. So the crucial takeaway here is this: without NVIDIA or someone just as big stepping up, Intel's dream of becoming the world's go-to foundry is essentially dead in the water.
Moving on to red flag number 3, the credit trap. There's this severe growing disconnect between the rallying stock price and Intel's actual underlying balance sheet. When you actually look at what the major credit rating agencies are saying, the picture is incredibly grim. Moody's projects Intel's debt-to-EBITDA ratio, which is basically just a measure of their debt compared to what they earn, is going to hit the mid-6x mark. Fitch is out there openly warning that Intel's weak metrics require nothing short of a miracle recovery to avoid a catastrophic downgrade. As of right now, Intel is sitting at a BBB rating. Guys, that is just 2 tiny notches above junk status. We are literally talking about the possibility of America's largest semiconductor maker teetering right on the edge of becoming a junk bond.
So, how exactly does a company hide a balance sheet that weak? Well, creative accounting, of course. Recently, Intel posted a staggering $3.7 billion GAAP loss. That's under standard accounting rules. But they dressed it all up in non-GAAP makeup. By adjusting the numbers with their own custom metrics to hide certain costs, they managed to present the illusion of a total blowout quarter to the public. They're losing money on an incredibly massive scale, all while the broader market is just cheering on the surging stock price. Now we arrive at red flag number 4, the political stranglehold. With the recent government bailout, the U.S. government essentially now holds a 10% golden share in Intel. We're going to look at this purely objectively, focusing entirely on the structural, financial, and operational risks this introduces to a publicly traded company. The primary risk here is beautifully summarized by this quote from Scott Lincecum of the Cato Institute. He warns that moving forward, Intel's operational decisions will be driven by political considerations, not commercial ones. When the government has a golden share, you really have to start wondering if the company is actually operating in the best interest of its shareholders or just, trying to satisfy political agendas. Critics and lawmakers are actively debating whether this level of government ownership edges a bit too close to state control, as the government gains heavy influence over private technological production. But the complications of this government involvement go even deeper when we look at the timeline. According to the source data, weeks before the bailout, President Trump met with executives from Intel and NVIDIA, meetings that reportedly made those execs pretty uncomfortable because of the pressure applied. Then, just days before the official announcement, highly unusual call option spikes suddenly hit the market. And finally, on announcement day, the government's stake is revealed, resulting in an immediate $4.9 billion paper gain. This highly suspicious sequence of events has led market observers and critics to question if insider trading occurred right before the public was made aware of the deal. Look, we aren't taking a stance either way, but the market data on those option spikes absolutely speaks volumes. Which brings us to our final section, red flag number 5, the ugly truth revealed. It's time to step back and look at the massive, glaring disconnect between the market's unbridled hype and the structural reality we've just uncovered in the data. Let's rapidly recap every single red flag dismantling this turnaround narrative. We've got a catastrophic 10% yield crisis on their most important technological node. We've got a foundry business bleeding up to $13 billion a year with no hero customer to save it. We've got a credit rating teetering on the edge of junk bond status, and we have heavy political interference coupled with clear signs of insider trading. Every single one of these factors shakes the very foundation of this so-called historic comeback. But hey, if you don't want to believe the analysts or the data or the leaks, you should probably believe Intel themselves. The single most powerful piece of evidence comes directly from their own SEC 10K legal disclosure. Right there in the text, they state plainly that they may suspend or terminate the development of next-generation leading-edge process technologies if they can't find outside customers. Intel is legally warning investors that they might not even survive as a leading-edge manufacturer. The truth isn't in the hype. It's buried right here in their legal filings. They're literally selling a future to the market that they openly admit they might not be physically able to build. So I want to leave you with this final provocative thought today. When the illusion finally shatters and the curtain inevitably falls on this whole narrative, who is actually going to pay the price? Will you be the one left holding the bag? Remember, whether we're talking about the 10% yield crisis, the billions bleeding from the foundry, the near-junk credit rating, the government golden share, or Intel's own SEC warnings, the information presented in this explainer is strictly for educational purposes only and is absolutely not financial advice. Always stay skeptical out there. Now, if you appreciated this structured approach to cutting through all the noise, please hit that like button, share this with someone who really needs to see the actual numbers, and subscribe to the channel so you don't get caught in the next hype cycle. We'll see you in the next one.